Hi, everybody. This is Leslie Girard. I'm here at Evergreen Home Loans and the Girard Team. I wanted to thank you for joining us today, and I wanted to share a little bit about our Listing Advantage program. So I appreciate you hopping on today's webinar, and I am going to just get started and get going. And I know everybody's time is valuable, so let's get everything started. I'm going to go ahead and share my screen. And talk to you a little bit about our Listing Advantage program. And the Listing Advantage program is a series of strategies that we have put together for your listings and your sellers. So let's get started. As we know, the market has changed a little bit this last 6-8 months, and we've gone to a very strong sellers market to a market that is a little bit more balanced. The buyers do have a little bit of more choices and a little more negotiating room. And obviously the rates have increased. And that's a concern for a lot of sellers. So one of the first programs that we have developed is what we call a lock and list program. So our lock and list program is a program where when you go out and you list a home, you can actually lock the listing into a rate. And basically you get the home listed. We will lock the rate at market for 30 days. And if the market does worsen and rates do increase, any future buyer will be able to obtain that house at that previously locked rate. So we're going to lock that rate on a base rate. So if let's say the buyer comes in with maybe a lower credit score, that base rate will be lower, and then the credit score loan level price adjustments will still apply. But if the market is shift to 0.5% or something in that 30 or 60 days, by the time that the buyer comes along, then they will be able to get that lower than market pricing. So there's an opportunity for the buyer on your listings to purchase that residence at under market rates. There's no cost to your seller. It's basically like free insurance. So it's something that you can go market out there with your sellers, and just something that you can put in your listing packets, and one more protection that you have for them. So it could make the difference when, if rates go up, that your seller's listing will stand out. So something you can have in your tool belt there. The next thing we have is we have a seller buy down. So we've been talking about this for a while, but we see a lot of sellers that have gone out and said, hey, I want to reduce the price of my house. The house isn't moving. And what we're saying is stop. Let's not look at that. Let's maybe look at a seller buy down instead. So what the seller is able to do is, let's say they have a house. There's an example here that, let me increase the size of this a little bit. This kind of just gives a little bit of overview on that. But in this example, let's say that the seller has a listing, and the house is listed for $725,000. They end up with a $636,000 loan amount. And the seller says, you know what, I want to drop the price of the house by $15,000-$20,000. You could recommend to that seller, instead of a price reduction, is offering that $15,000 so that the seller will fund what we call a temporary buy down for the buyer. And what that is let's say they have the buyer has a note rate of 6.5% on a 30-year fixed rate. With the sellers, in this case, $14,475, they would be subsidizing that first year and able to get that buyer, instead of a 6.5% rate, let's say where market is, that first year, the buyer would be making their payments back based on a 4.5% rate. So they're going to be 2% under market, which is going to save that buyer in this scenario almost $800 a month for 12 months, or almost $10,000, about $9,569 for the first 12 months of that loan. Then the second year for that buyer, again, they're still at the 30-year fixed rate. But the second year they would go to a 5.5% rate, and that's what their payment is based on. So their rate is still 1% below market of the 6.5%, and they're going to save another $408 a month that full second year. So almost another $5,000. So over that first 2-year period, your buyer or the buyer on that home is going to save about $14,475 out of pocket. Now, if the seller were to take that same $14,000, $15,000 and just do a price reduction, great, that's good, but that's only going to really impact the buyer's payment by about $95 a month or so. So it's a better use of funds you really want to attract some buyers, because what we're seeing now is so many buyers have payment shock with where rates are. And many of the buyers that we've been working with, you know, they were thinking about buying a house when rates were 3 or 4. Now they're up in the 6s, some of them pushing in the 7s, and they just don't want to jump in that much into a payment. So a program like this, where they can actually ease into that payment at a 4.5% rate the first year, 5.5% the second, and then years 3 through 30 at 6.5%, it makes it a lot easier for them to want to get into the market to buy. Now, again, just depends on what the 30-year fixed rate is. That's what this whole buy down will be based on. And then the cost to the seller basically is that annual cost savings over that 2 years. So you can do a 2-1 buy down like I'm showing here. We've just closing on one this week where the seller didn't have the resources, I guess, to really pay for the 2-1. It was a lower priced home up in Cowlitz County. And so they did a 1-year buy down. So again, the buyer was able to get into a rate 1% below market for that first year. His payment's going to be based on that. And then in that case, the second through the 30th year, he'll be at his 30-year fixed rate. We can also do it on a 3-2-1 buy down. So if the market rate's 6.5, they could actually start at a 3.5% rate for 12 months. Second year, go to 4.5. And then years 3 through 30, or excuse me, the next year, 5.5. And then the next final years would be year 4 through 30. They would be at that 6.5% rate. So there's a lot of really good options for the buyers out there to help your listings stand out, to be able to offer some things that are really going to benefit the buyers. So again, if the seller is already thinking about doing a price reduction or wanting to pay seller closing costs or something to attract buyers, this is a great strategy to use. The amount of the buy down is going to be different for every day, basically. I mean, we can give you a good ballpark, but it depends on what rate that the buyer locks at. And it depends on the savings, because basically what the seller is doing is they are funding that exact amount. So when the offer is written, the addendum isn't going to state X amount to seller closing or buyer's closing costs. It's going to say, we're going to give you an exact dollar figure to say the seller to pay X amount to for buyer's seller buy down program. So we can give you that exact verbiage at that time. So that's another great strategy that we're using quite a bit, but something great to talk about on your listings. The next strategy is just some tools that we have, some marketing resources. So we have, we're a list reports partner. So what we have done is we have negotiated marketing packages for our agents, those that are interested. There's no cost to you as a real estate agent, as a partner, but you will have access to some great tools, both on your mobile app and also marketing kits. There's just listed, open house flyers, under contract. There's a lot of digital assets. There's also social media, neighborhood reports, and several other property websites, postcards, you name it. Some great resources. Again, no cost to you. I just need to send you a link. You can get everything set up. You can use what resources you want. Don't have to use the one, but I know a lot of folks are pinching pennies and maybe dropping some of their marketing platforms. So this is something that agents can plug into that are looking for some resources to market. The next part of the Listing Advantage program is the conversation around assumable loans. So this is something you really want to talk to your sellers about. So if you're working on a listing or you have a listing and you need to ask your seller, just say, hey, what kind of loan do you have currently and what rate are you at? Because if they have an existing FHA loan, if they have an existing VA loan or a USDA loan, wherever they're sitting on their rate, that loan is entirely assumable to the new buyer. Now, there are some caveats with conventional loans as well. But basically the FHA, VA, and the USDA are given. And just some bullet points on that. The buyer coming in, they must qualify. So they can't just walk into the loan and not have qualified. They have to qualify to take over that mortgage, just like if they were to get a new loan. So they have to meet the qualifications with credit score, debt to income ratios, and all that. They also have to come in with the seller's equity. So if you have a seller that has a home listed for $500,000, and let's say that they owe $400,000, you'll look at their payment coupon would be a good indicator. The equity, the buyer's going to have to come in with that basically as a down payment, because the sellers wants their loan assumed and they want their money. So the cool thing is the buyer not only assumes that current balance, but they also assume the remaining term and also the escrow account. So for example, if you have a seller that has a loan that has a $400,000 current balance, you're selling the house for $500,000. The buyer is going to qualify for that loan to make sure they can qualify for that $400,000 at that, let's say 3.5% rate or whatever it is. They're going to have to verify they have the assets to come in with that equity that they're going to owe the seller. There are some situations where they could get a second mortgage or a home equity line or some other ways to come up with those funds if they don't have the cash. But if they're 5 years into that mortgage, we're in 2022. Let's say they got that mortgage in 2017 and they're already 5 years into that mortgage. The buyer comes in and they're only going to have 25 years left on that mortgage, or maybe it's 25 years and 3 months, whatever it is. They basically walk right into that timeline on the date of closing. And it's almost like that seller says, yep, here's my payment coupon book. Here's everything. You just plug right in. And the next month they just pick up where the seller left off. So that remaining term. So it's a great way. They don't start with 30 years from the get-go. It could be 29 years, it could be 22 years. It just depends on where the seller is in that mortgage. And then there's the escrow account. So assuming that the seller has taxes and insurance included in their payment, what's going to happen is at closing, it's going to be like a proration. So we're going to want to find out how much is in that escrow account, how much money is sitting there for taxes. And you're going to want to think about in the negotiation of this is, will the buyer reimburse the seller? Because the seller's not going to get that money out. Any money in that escrow account is going to remain. So if they're, let's say we're in March and they've got 7 months of taxes at $500 a month, so they've got $3,500 in taxes sitting in that account. The buyer walks into that loan and he'll keep that money too, because the mortgage is continuing on just with another name on the loan. So usually what happens is when assumptions are written up, the buyer reimburses the seller for any funds in that escrow account. So the money will stay there, but if there's whatever the balance is in that escrow account, the buyer is going to bring in those funds. So in addition to that equity or down payment, they're going to bring in those additional funds to reimburse the seller for that escrow account. So just something to kind of think of there. One caveat that a lot of folks aren't aware of is we're talking about FHA, VA, and USDA loans. VA loans can be assumed by a non-veteran. So if I wanted to go buy a house, I am not, oops, excuse me, calls coming in. I am not a veteran, but if I found a house that has a 3% loan, 30-year fixed loan, VA, and I had the money to, or I could get a second or a gift or some other source to come up with that equity to give that seller the difference, I could walk into that VA loan and assume it to the end and not be a veteran. The caveat you have to keep in mind is the seller, and again, I'd have to qualify for the mortgage from a basis of income and credit, debt ratio, things like that. So the seller, their VA eligibility is tied up until that loan is paid off. So if I assume that loan, that seller who's a veteran, if they want to buy another home and use their VA, they won't be able to use their VA again until I pay off that loan or sell the house and it's paid for. There is a thing called bonus eligibility. So what that means is, let's say I assume a VA loan and the seller moves on and they don't, they're not sure if they're going to need a VA loan again, or maybe they have enough to do a conventional this time, but let's say they want to do another VA loan, but if I assume their loan, I'm going to tie up their eligibility. We can do a worksheet. It's a calculation. We get a copy of the seller's certificate of eligibility, and it'll tell us if there's any bonus eligibility available. And what that means is there enough eligibility left for them to buy another home with a VA? So technically a veteran can have 2 VA loans if they have enough bonus eligibility, but that has to be calculated based on the veteran certificate of eligibility at the time. So that's just something to keep in mind. One of the other caveats on the assumable loans is it could take a little longer to close. So Evergreen Home Loans, me as a loan officer here in town, I can't take your buyer and say, I'll help you, get this loan closed. You would have to actually look who's on the payment coupon. And if it's ABC Mortgage, you would have to call ABC Mortgage, have to get a copy of their assumption package and all the paperwork and submit it to their current mortgage company and go through that approval process. And that can take a little longer, just depends. Some companies are better set up. Assumable loans are becoming more popular. So it just depends on if they're, kind of what their turn times is. So you'd have to kind of find that out. But the really cool thing is for the buyer is there's virtually no closing costs. I want to say around $900. There's a maximum that lenders can charge in these assumable loans. So it's pretty darn inexpensive compared to starting a whole new loan. Now, we can't help you through that process directly. We can't do a loan. We can't do anything when it becomes the assumable, but what we can do for you is we are happy to vet that buyer for you. So if you have a listing that has a assumable loan and a buyer comes and says, hey, I want to do this, you give them the packet, you can send them to us, and we are happy to pull credit with their permission, of course, look at their income and their assets, and take a bird's eye view, so to speak, pre-qualify them and let you know if, what it looks like. We can look at it pretty quickly and say, you know what, credit looks good, debt looks good, they have the money to do this. It looks like a safe bet. Or we could look at any potential red flags and say, oh, credit's pretty low, they don't look like they have enough money. Or if we see any potential roadblocks, we can let you know that as well. So we can kind of do some buyer vetting for you, just more of a courtesy before you get in the process of an assumption and find out 30 or 60 days later that the borrower doesn't qualify. So we'll do that for you. Again, it's a courtesy. And but some assumable loans, it's a great tool out there. The last thing I wanted to mention on that, I have folks that say, well, if it's an FHA loan, it's got mortgage insurance. Why, if they have $100,000 down and they could go conventional without mortgage insurance, why would they want an FHA loan, even at 3% or 3.5%, and have to pay mortgage insurance? Well, if you do the math, on an FHA loan or even a USDA loan that has a monthly mortgage insurance or guarantee fee, if you have that low of a rate and add the mortgage insurance, that payment is still going to be much cheaper than if you got a new loan at today's rates with no mortgage insurance. So it is absolutely, if it's a dollars and cents and it's about monthly payment, more often than not with these lower rates and mortgage insurance, the payment's going to be a lot less expensive than a new loan, conventional 20% down or 10% down with no monthly mortgage insurance, even with the lender MI situation. So definitely something to talk about it with your seller on your listings. Make sure you check that box of an assumable loan, have your seller get the assumption packet so you have it in hand, you know it's entailed. And again, we're happy to look at that for you. So that's a little bit on the assumable loans and looking at the rates of yesterday that are unfortunately gone for now, but I think in another couple of years or less, we're going to see them come back down again. So the next part is we have our step up program. So a step up program is a program where if you have a buyer that wants to buy a home, one of your listings, and the seller's like, I'm not going to take a non-contingent offer, or I can't take a non-contingent offer because I have a house that I want to buy, then we've got a great program. It's called Step Up, and it's a way for a buyer to purchase your listing and be non-contingent, even if they have a house to sell. So here's a couple scenarios here. So if you look at option A, the buyer has money for the down payment. So they use their cash, and let's say it's that $500,000 home, and they say, you know, I've got 20% down. I want to use that down payment. Or maybe they're B and they're like, I don't have a down payment. I want to buy the house, but I don't have enough for down. So in that situation, we would do a bridge loan on their departure residence, the one that they're going to eventually sell. And we would pull the equity out of that house and use that to put down on the new house. And that's where our step up program comes in. So they get pre-approved, either if they have their own money or we do a bridge loan for them. They get pre-approved for the step up loan, and that is a portfolio loan. So Evergreen Home Loans, we take our own money and we're going to do a private money loan and help the buyer purchase your listing without selling the house. And that private loan is a bridge loan, basically. It's a portfolio loan. We're going to get that loan closed, and we're going to give them a period of time to get that, not only get the loan closed, but once it's closed, we're give them some time to get their other house sold. So a lot of times people can swing it with the down payment and qualify for both payments. But what most people, even if they have the down payment to make a new purchase, a lot of times they can't qualify to carry the old house payment and the new house payment. So because we're going to do what we call a portfolio purchase loan, and that's our money, we make up our own rules basically. And we say, you know what, we'll help you buy the house. We don't care that you have this debt over here because we know this loan on the new house is temporary. And we're going to give them that temporary loan, and they're going to make some interest only payments while they have that. And then once their old house sells, they get the equity from that. We're going to take those funds and we're going to apply that to the new purchase or the new house that they bought. And we're going to refinance that temporary loan into their permanent financing after. So by the time we do their permanent financing, that old house has gone and sold, so we don't have to worry about the debt ratio. So they can make a purchase, they can close with the portfolio loan, they sell their departure residence, and then we finalize their permanent financing when we do the refinance of that portfolio loan down the road. So I'll introduce a little bit about my team. Obviously myself, Leslie Girard. I have Suzanne Cavella. She's also a loan officer on my team, and also Laura Koch, both seasoned and very wonderful, smart ladies that can help our clients all the time get in those homes that they love. So the last piece, or one of the last pieces I want to talk about, is sellers relocating out of state. So over the last couple of years with COVID, remote work, sometimes politics have come up in conversations, but people are relocating a lot of times, not only into the area, but out of the area and all over the United States. So my team and I are licensed in several states. So if you have a seller that wants to relocate and become a buyer somewhere else, we would love the opportunity to help them get pre-approved while their home is listed. We'll help them get pre-approved so they're ready to make a purchase in another state. Maybe they could use that step-up program with the, if they want to buy before the house sells, we can help them there also. But we've got a lot of licensed states. We got California. We're licensed in Montana, Arizona, Idaho, Nevada, Oregon, of course, Texas, Wyoming, Washington. And I need to update this because we do have Florida now as well. So we've got a lot of states. We have still more coming on. So if you have a seller that is relocating out of the Northwest, somewhere else across the country, let us know. We would love to help them get pre-approved and maybe use one of these tools on their next purchase. And that's where this comes in. Most of the time your seller becomes a buyer. And we talked in the beginning about how we can protect your listing, the seller's home when it's listed. We can lock their house in, so we can offer that house at possibly below market rates if rates were to increase. Well, what happens when your seller has their house listed? They let's say 30 days, they get an offer, another 30 days it gets closed, and we've protected the buyer. And let's say the buyer's like, great, I could use that below market financing now, but your seller's sitting there and it's 30, 60 days down the road and rates have slowly crept up on them while they've been sitting waiting to sell their house. So we can use our lock and shop program for the seller when their house is listed. And we can do that with a float down option if they'd like. So not only do we lock the seller's home for a future possible buyer to take advantage of it, but we can lock the seller in for 30, 60, even 90 days. So when their house is sold and finally closed, they have that same right protection. They can apply to any home out there that they decide that they want to buy. So they can take advantage of the lower rate. So let's say something happens, we don't really expect it, but let's say we've got a huge improvement in 60 days and we've locked them, let's say, at a 6.5% rate. And, they're protected in case they get up higher than that, which is great. But what if rates drop to 6 by that time? Well, we can do a float down option. They can choose that option. We can float the rate down to market as well, if they choose that float down option. So again, there's no cost here to the seller, which will now be a buyer, to give them that protection for any possible future rate increases when they become that buyer. So it's available on conventional loans, FHA, VA, USDA loans. Again, it's for purchase transactions only. And we can do that up to 90 days. Again, we do have that float down option. If the house sits on the market for a little bit, we can also extend if we needed. As the market, hangs on, if it looks like rates are still increasing and we get past, let's say we do a 60-day and they're like, not quite have it sold yet, we can extend for another 30 or 60. So anyway, we just want to make sure that your customers are protected, whether they're listing their house, they're relocating to another area, or they're selling their home and becoming the buyer. So that's kind of in a nutshell of the listing advantage program that we've put together for your listings and for your sellers. I appreciate you hanging out with me today and taking the time to jump on this webinar. And if you have any questions, feel free to reach out to us. We can be reached at 254-2610. Myself, Suzanne, or Laura can assist you. And we'd love to chat with you further, give you a few more details, fill in some blanks, as maybe you would like to learn more about the program. So ping me at L Girard, Leslie Girard, L Girard at evergreenhomeloans.com if you have any questions, and we would love to chat with you further. Anyway, you guys have a great day, and we will talk to you soon.